Hey everybody, today we're going to be doing another ETF review, and today we're going to be looking at the First Trust Dow Jones Global Select Dividend Index Fund, which is a mouthful, so I will be referring to it as FGD from here on out. I chose this fund because it's had a very good run-up in the recent year or so since the market crash, and it's not a particularly popular fund or particularly large, but if you search, say, Google or another search engine for good ETF funds with dividends or good dividend ETF funds, this one pops up in quite a few lists and quite a few articles, so I thought it would be good to look at. Also, this one gives a particularly good lesson on why and how you should do research into funds. So let's start by looking at what the fund is exactly. As we can see here, it invests in component companies of the 25 developed market country indexes in the Dow Jones Global Indexes family, which essentially means that of the 25 developed market countries that the Dow Jones has indexes for, this will invest in companies that sit inside those indexes. Below that, we can see that it has other criteria such as paying a current dividend, having a particular payout ratio, a particular volume, so on and so forth. So it is good to see that they actually have a strategy that they're going for. They're not just picking and choosing, hype stocks like an ARK ETF or something like that. We can also see that it is a passively managed fund as it is reconstituted and adjusted annually. Next, whenever we look at an ETF, one of the first things we want to look at is the expense ratio. And as we can see here, we are at 0.57%, which is rather high for a passively managed fund. Once you get over 0.5%, you're really into actively managed fund territory. Any kind of index fund, I really want to see below 0.5% and preferably below 0.25%. A lot of index funds you can find for under 0.1%. So seeing that 0.57, it's a little concerning, but if you're getting great returns, then it's okay to pay a higher expense ratio, but we'll see if we are getting those returns. As I said, it's not a particularly large fund, only $500 million. There are tons of funds that are in multi-billions, tens of billions of dollars, so it's not huge. But we'll see if that small size has anything to do with it. We can then go over to our dividend yield, and we can see that it's really sitting at about 3.5%, which is pretty good for an ETF. If you were to buy an S&P tracker ETF, you'd be looking at about half that, somewhere between 1.5 and 2%, and even something like SCHD in a dividend appreciation ETF, you're looking at probably 2.75 to around 3%. So it's beating out those. That's a pretty nice yield. Now, of course, we need to actually have returns to go along with those yield returns, because it doesn't matter if you're getting 3.5% in yield if you're only getting 2.5% in appreciation, while funds with lower yields are doing 10% in appreciation. So, after that, let's look at the actual fund as it is. We can see some top holdings here. I won't go into that too much because a lot of these are going to be foreign companies because this is a global fund, so there's probably going to be a lot of stuff you don't see, but there are some things you might see, like British American Tobacco. Most people know Lumen Technologies is rather popular, but there's going to be stuff from a lot of countries that you might not know, so just keep that in mind. Then we can go to our country exposure. This is a global fund again, so you're going to have different countries, and as we can see, it is actually relatively diverse. North America does get the most here, with Canada and the US accounting for about 28%, but there's good exposure. We have South Korea, the UK, other Asian and European countries, so a good diverse set of country exposure. Nothing really surprising there. That's pretty cool. Next, we can go and look down to our sectors, and this is a bit of a red flag here, and this is why research is important. We can see that of the different sectors, financials make up half of the fund. That is quite concerning. After that, it gets to be relatively diverse, but that's only for half the fund. Here, you've got half of your fund in financials. There's no real diversity there. If I was just glancing at this without going into the sector exposure and I saw, oh, this is a global dividend fund, I might think, oh, that's pretty diverse. I'm going to get different countries, different sectors. Here, you're not really getting sector exposure. After you get past the first 4 sectors, you're really into almost nothing. You've got 75% in 4 sectors here. This big financial allocation is very concerning. But perhaps that it's doing really well with that being so well into financials is giving it really great returns. It's done so over the last year, so maybe that's something good. We can keep looking at that. Next, let's look at performance. And as we can see, over the last year, the fund has done about 61% returns, which at first glance sounds amazing. But if we go back further, we can see that performance drops off significantly. The fund was incepted in 2007, right before the crash, so this is a little misleading. As you can see, we go from a $10,000 initial investment to losing 63%, but that was really a black swan event. You can't really fault the fund for that much, though it was heavily invested in financials. Still, that was a once-in-a-generation event, so to speak. But even so, going back over the 10-year, we're still only doing about 6%, and even the 5 and 3-year only about 9%. The market's going to do about that, and that's including dividends. And the market's going to do about that over the long term, but over the short term, the broad market has done even better than that. So our performance is kind of bad here. And if we actually backtest this against other asset allocations, we can see that in our first backtest, we have the FGD in our first portfolio. In our second portfolio, we have SCHD, a good dividend appreciation ETF. And then in our third portfolio, which I didn't do correctly, let me fix that for us right now. There we go. We have VOO, which is just a Vanguard S&P 500 tracker ETF. Now, if we actually look at the performance, we can see that it's rather stunning. Now, note that this is after the financial crash in 2007, 2008, 2009, starting in 2012. Once we got to 2015, we diverged heavily from the market. We can see that our dividend and wide market ETFs here are both at around $40,000. SCHD doing slightly less than VOO, but not by a ton. But here we can see that our FGD did terribly, doing less than half of the wide market over that time. To say that is bad is an understatement. How bad is it? Well, we have another backtest we can look at here. In this one, we have FGD in our first portfolio, and in our second portfolio, we have a fixed income ETF, something that shouldn't grow by that much. You're really just looking for income with very little capital appreciation in ILTB, which is just a broad 10-year U.S. bond ETF, and we can see that even now, with its current run-up, it still hasn't gotten back to where a bond ETF has over the last 11 years. And if we went back to the crash, it was almost half of that. So we can see that over time, this fund has not performed very well at all. So what does that mean? Is this fund for anyone? It has had a good run-up in the last year, which someone could make an argument, and they'd be correct about that. However, over that same period of time, the S&P has returned almost 100% since the bottom, going from about 2,100 to about 4,200, whereas this has returned only 60%. Sure, you're getting a 60% return, but you could have gotten a nearly 100% return, and there are plenty of tickers out there, stocks and ETFs alike, that have gone up by hundreds of percent, some even thousands of percent in that time. Granted, there's a little speculation involved there, but you could have done just as well, if not better, much better, with a simple S&P 500 tracker ETF or something like SCHD. So is this fund for anyone? No. And that's why I wanted to bring this fund in particular up. This fund is what I like to call a law-abiding scam. The people who run this fund aren't doing anything illegal. They aren't technically misrepresenting, but this fund is a way for them to make money while putting something out there for uninformed or unintelligent investors. If we actually do a little math here, we see that at $520 million times 0.57 on the expense ratio, they're making $3 million a year for over the last roughly 13, 14 years for the the ticker to go nowhere. It incepted at $30 and it is currently sitting at $27.39. Or I'm sorry, that's the closing NAV, the closing market price being $27.41. So the ticker is actually down 2.5% since its inception, and the yield is not making up for that. Once you factor in taxes, inflation, and your expense ratio, you're most likely going to be losing money here. If you're in a higher tax bracket, over $40,000 a year, you're losing money with this ETF unless you got really lucky and bought it last year during March. But again, you could have bought a simple S&P 500 ETF with a much lower expense ratio that would have done much better for you. So again, this fund, really not for anyone if you were to ask me. Now, again, why I wanted to bring this one up in particular, it's not particularly popular, it's not particularly large, but if you were to look for it on Google or a search engine, it's going to come up if you look for dividend ETFs. As we can see, it has a 4-star Morningstar rating in its category. But what does that mean? That just means that among similar funds, it does better, but it's still not doing good. It's still not doing well compared to the S&P 500. This is why research is important. You could looking at this at first glance, you might go, "Oh, this is up 60% over the last year. This has a strategy that they're sticking to. This is something I could invest in." But even just going through 10, 15, 20 minutes of research, you can see that this is a lemon of an ETF. There is nothing here for a serious investor. Even for a passive investor, you could find much, much better funds that are going to give you much better returns with much lower expense ratios. So again, that is why research is important. It took me longer to record this video than it took to do the research for this fund. And why is that important? Because it's not just funds like these. This is a small fund. It might not really matter that much. It might not have that many investors considering its size, but there are multi-billion-dollar funds that are very similar to this, with the same, if not higher, expense ratios with very similar returns. This is why fund research is important. You need to go through the fund, you need to backtest it against similar or even different funds to see what's going to do well, and it'll keep you from, in this case, losing money over the long term, and in other cases, making very little compared to the market. So I hope this helps, and thank you for watching.